So are they preparing to do gold revaluation? Even the Federal Reserve Board now, on August 1st, they published an article about how this process works, and they'd never done that before. But what it would do, it would put a floor under the gold price. Back in '73, when they revalued it to 42.22, we never saw that price again. And by 1980, the price of gold had gone up to like almost 900. If they revalue to a level where they got, let's say, around 6 trillion, they could actually go to the Federal Reserve and buy almost all their assets. And then the Fed's balance sheet would go back before the '08 crisis. And then they can start inflating the credit system again. I've been calling for hyperinflation or currency collapse. I think there's still a lot of people out there who don't see it happening.
Welcome to the Microscopic Podcast presented by GoldRepublic. My name is Alexei Joranov, and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold. Just click on the link in the description. Today, my guest is Mario Innecco, better known to many of you as Maneco64, the voice behind one of YouTube's most trusted channels for sound money commentary, alternative economics, and contrarian takes on the global financial system. A former City of London trader with over 20 years of experience in government bonds and derivatives, Mario has spent the last decade covering fiat currency debasement, gold and silver suppression, and the daunting reality of financial repression. He's a passionate student of monetary history, an advocate of the Austrian economics school of thought, and one of the clearest voices warning that the current system is heading towards a reset, whether by design or collapse. Today, we're diving deep to understand his thesis. It's an absolute pleasure to finally be able to talk to you, Mario. Welcome to the podcast.
Oh, thank you. And it's a pleasure speaking with you as well, Alexei.
So one of the first questions I ask for the guests I interview for the first time is the simple one, but yet interesting, is what is your most contrarian or heretical view on the monetary system today?
Contrarian and heretical. Well, I guess I've been calling for hyperinflation or currency collapse. And I think there's still a lot of people out there who don't see it happening, but I do. And yeah, that's it.
Okay, well, maybe we can dive into that on why is that people don't see it, and maybe actually because you've won over reset. If people follow you, they know that you've been talking about this consistently for at least the last 10 years since you've created your channel in 2015, and you said that the reset has already been happening since 1999. Through the Dow gold ratio, if I'm not mistaken. So what does exactly this ratio reveal about the underlying fragility of financial assets today?
Well, the Dow gold ratio, if you go back like over 100 years and into the 1920s when there was the stock market bubble that burst in '29, that ratio topped back then around 20. And then it dropped to 2, I think. And then it took another 32 years for it to go up again. In 1966, 67, it went up to 26. And then it dropped to 1 in 1980. And then it rose again to like the mid 40s by the end of 1999. And the reason why I say the reset has been ongoing since then is because what the Dow gold ratio reveals, in my opinion, is the preference for gold or real money versus paper assets. And that's what it really implies. The fact that it's been going down since then, of course, it hasn't been going down in a straight line, says that more and more confidence is being lost in financialization and paper assets. And the gold is like the premier, let's say, indicator of hard assets and real things. So that's what I think it's implying. And I think, yeah, a reset is a correction. So uh, if we price stock market in terms of the Dow, even the S&P in gold since the beginning of the century, they've actually been losing real value. And I think they're going to continue to do so. And unlike, let's say, an overnight reset, which happens when governments and central banks adopt a policy, let's say, over a weekend, yeah, the reset I'm talking about is more gradual, of course. And a lot of people have lost out, in my opinion, because they've been in paper assets. And I'm not saying they haven't done well, but I think being in gold is very safe, and it's done a really good job since 1999.
So if that says, I mean, you've tracked this ratio since quite some time, the Dow gold ratio. Do you have a target where it could fall to? Or what would that imply for the stock prices or in gold in dollar terms?
Yeah, I think, well, in 1980, it went down to one. It was went down to two in 1932, 33. So it could very easily go down 1 to 1, or it could even go half. You only need half an ounce of gold to get a full Dow. Um, I have a feeling it's going to be at a lot higher prices, both for gold and the Dow, because I see a hyperinflation and a melt up in the stock market, and gold is going to follow and it's going to outperform. But it's difficult to say at what prices they would cross. It could be 50,000 each, so it would be 1 to 1, or it could be gold. If we could see, let's say, a melt up continue, gold doesn't catch up with the Dow, and then you see a collapse, let's say in the stock market, but gold stays pretty steady, let's say at 10, 15,000, but then the Dow drops to 15,000 as well. Or, yeah, there's all kinds of repercussions. But one thing that I think the Dow gold ratio indicates is that when it's near one, that means that it's probably a good time to get back into financial assets, actually. So, not saying you should get out of all your gold, because gold, in my opinion, and silver to some extent, they're all like saving instruments.
Clear. And also you've argued that the 2000s have been in actually a hidden depression masked by this fiat inflation. What would you say are the real indicators, except CPI, which we will go into detail a bit later, that people should understand or are overlooking?
Yeah, I mean, you look at the price of gold. I think you measure a lot of things in gold. You measure the stock market, you measure the price of oil, you measure even real estate. Here in the UK, the average house price was you needed over 600 ounces in 2004. Now it's just over 100. The other indicators, I guess, is the how the younger generation, uh, they've been having a really, well, they have a really tough time, not just in Europe, even the US, getting, yeah, getting on like building families, buying their own property to live in. A lot more younger people are in their 20s and 30s still living with their parents. It's really, really tough. And also, like here in the UK, for example, we have a lot of food banks, which is where people go to get like free food. from charity, and even people who are working go to food banks, and that's something that was unheard of 20, 25 years ago. So there's a lot of small anecdotal evidence, not small, but there is anecdotal evidence that things are not great. The other one I would say is the political unhappiness and uncertainty and volatility in politics. You have to admit, politics now in Europe and in the US is a lot more divided. And I think that's a symptom of that too, because a lot of people are unhappy with what's going on, and they're blaming the people in power.
So, what would you say is then the core of the problem? You often talk about the fact that central banks are the let's say main perpetrators of this ache, this monetary ache that we're witnessing in the monetary system. Would you think that the economy would be run better without any form of monetary policies implemented by central banks today?
Yes, definitely. I mean, would it be better to have a central restaurant running all the restaurants in the country? Uh, no, it wouldn't, because there wouldn't be any competition. You wouldn't have the good chefs opening their own restaurants. So it's the same thing with money and banking, in my opinion. But the other thing I think that central banks do and the fiat currency system do is that they allow politicians to promise almost everything to the electorate, and unfortunately, I think yeah, the general public usually buys into it. So the public is to blame for it as well, because it's really difficult to and tempting not to take freebies from politicians, and people just keep taking it. They get used to it, and then when someone comes and tries to take that away, not just the public will get angry, but also the politicians that depend on it. They'll get angry, and they'll try to cancel it. And I think there's a lot of probably politicians out there, or aspiring politicians, who are trying to do the right thing, but they're canceled. Even though personally, I don't trust politicians of any ilk.
So I want to go back a bit on the reset thesis. You and also Clive Thompson, which you also invite and interview on your channel on a regular basis, have talked about gold being revalued to, I think, $15,000 an ounce as part of the statutory reset. How would that mathematically work, and who pulls then the trigger?
Yeah, I mean, yeah, the U.S. Treasury officially has 8,133 metric tons of gold, and the Federal Reserve has gold certificates that are claimed to that gold. And the reason that happened was back in 33, when Roosevelt, when he took in all the gold. He made gold illegal, and people had to hand in their gold and take Federal Reserve notes for it. All the gold came through the Fed regional banks, and then the Fed regional banks gave the gold to the Treasury, and the Treasury issued these gold certificates. And that was at $20.67. And then in 1934, they came out with the Gold Reserve Act in January 30th, I think, 1934. And that day they revalued gold to $35. And the Fed sent the profit to the Treasury, because the gold was taken in at $20.67, and the revaluation, yeah, they sent the profit to the account of the Treasury, and they kept those certificates. And then in 1972, after Nixon closed the gold window, the Congress revalued that price from 35 to 38 because, yeah, the international price of gold was going up, and yeah, it didn't make sense to have the price at 35. They revalued it again in 73 at 42.22. And by then, gold was almost at 100. So they're always late, but they haven't revalued it since then. So all that gold and the certificates at the Federal Reserve are worth about $11 billion. So if they revalued the gold certificates to, let's say, $3,400, that would be that would be about 800 billion in profit for the Treasury, and they would have to write new certificates for the Fed at 3,400, and the Fed would send the profit to the Treasury, and they could use that to do whatever they want to. So if you revalue it to 15,000, I mean, that's a much bigger number. I think Clive came up, I don't know how much it was. So that's about four times. So it's about 4 trillion. If you do it to 30,000, that's 8 trillion. So they could choose any number. But the thing is about revaluing, and we saw the other day, Alexei, that even the Federal Reserve Board now, on August 1st, they published an article about how this process works, and they'd never done that before. So are they preparing to do a revaluation? I don't know. It's just speculation. But if they revalued it to the market price right now, let's say 3,400, yes, they'd have an extra 800 billion, the Treasury. That would help them. But what it would do, it would put a floor under the gold price. Because back in 73, when they revalued it to 42.22, we never saw that price again. And by 1980, the price of gold had gone up to like almost 900. So it would be, even if they revalued it to 3,000, for example, it would be very bullish. They might want to do it a little more than the current market price, maybe because they might want more profits for the Treasury. They might just let the market keep going higher, and then maybe in 6 months to a year announce it, let's say at 4,500. Or they could announce it over the weekend at 10,000, and that would basically close down the gold and silver market probably for a week, because things would just go crazy. I don't know what would happen, and that's why I tell people it's better to be early than one day late, and that's why I say, yeah, you need a little bit of physical gold and silver.
So let's take a step back. If that would be the case, and that might actually be quite desperate measure if they really trigger this, even if that, let's say what you just mentioned with the at $30,000 an ounce, that would be approximately 8 billion.
Trillion.
Trillion.
Yeah.
Trillion, different numbers. But the US debt is around 37, 38. So that would be just a temporary, well, glitch basically, because that would not even represent 20, 25% tops of the actual total outstanding debt. That would still also have repercussions, obviously, on the dollar and its purchasing power abroad, and maybe that's one of the most important, the credibility of the Fed and the dollar as a whole in terms of institutional credibility. What would be the, let's say, the play out on this?
Yeah, no, I agree with you. It's difficult to tell what the repercussions would be for the dollar, but it's been done before. I was reading actually the Fed paper that came out recently. Germany did it in '97. Italy did it. One thing is that a lot of countries now, especially China and Russia, they've been buying a lot of gold. They would do very well as well. So would European countries that have a lot of gold. In terms of the debt, if you look at the debt owed um, to foreigners, Treasury debt is about 8 trillion. So that would be how can I say, just over 20%. And even during the 19th century, when there was a gold standard, countries like Britain, they kept like a 33%, 30% gold cover. So yeah, it might not sound that much, 8 trillion out of 37 trillion in debt, but a lot of people argue that uh, the gold cover should be more related to the money supply, i.e. M2, and M2 is around 22 trillion. So eight trillion wouldn't be that bad. I would say it would be like a 40% cover. And when the Fed was created, uh, or back in the 30s, they used to have a 40% cover. Every Federal Reserve note needed to be 40% backed by gold. So I don't think it would be a problem. And I guess if the US did this every 5, 10 years, this revaluation, then yeah, they would lose credibility. But they've waited, if they do it, they would have waited over 50 years. So yeah, what's and the other thing you might say, why you're valuing your most valuable asset at $42 if it's worth so much more. So yeah, it might affect things a bit, but I actually think it would be bullish for everything, for the economy. It won't solve the problem of debt, because I still think politicians are addicted to it, but it would buy them time.
Clear. I mean, yeah, as it always does. Short-term thinking and thinking about the next elections. So let's talk about the let's say the trigger points that could lead to this scenario. And you very often always refer to the most important of markets, which is the bond market, and more specifically the U.S. Treasuries. And you've warned that the U.S. Treasury is actually now essentially running monetary policy and not the Fed, if I'm not mistaken. So how are they pulling that off without headlines catching on that?
Yeah, because the bond market is a market that is not followed by the general public. When you listen to the news, financial news, or any news, especially, well, at least here in the UK, they say, the stock market did this and the currency did this, but they never talk about bond yields or anything. So, and what the Treasury is doing is something very technical. So that won't even see the light of day in the mainstream news for the general public. So what they're doing is they are issuing more short-term debt, so that there's not that much pressure on the longer-term interest rates. So they're doing actually what Janet Yellen was doing, and they were critical of Janet Yellen. The other thing they're doing, I saw that they can buy back like existing debt, long-term debt. When they issue short-term debt and they get the cash, they can go in and buy 5 and 10 years debt. And I think they're doing that. Actually, they announced it a couple of weeks ago, the Treasury. So that's how they do it, because right now the Federal Reserve is still doing quantitative tightening. They're still selling their treasuries or letting them roll off without adding them back on. So yeah, they can do it, and they can kind of do yield curve control, which is usually the something the central bank does. So the other thing with a possible revaluation, let's say if they revalue to a level where they got, let's say, around 6 trillion or maybe a little less, they could actually go to the Federal Reserve and buy all their almost all their assets, because the Fed's balance sheet is like just under 7 trillion. That they could go and buy 6 trillion worth of it and retire all that debt, treasury debt and mortgage debt, and then the Fed's balance sheet would go back down to like 800 billion, which was where it was before the '08 crisis. And then they can start inflating the credit system again. Maybe that will happen once we get that 1-to-1 Dow Gold ratio. That would make sense, because from then they can start again. It's going to be another 30, 40 years maybe of boom. But before that, it's going to be painful. And it's already painful, I think, for the majority of people. It's only the people at the top and the very wealthy that are benefiting right now, because asset prices are going up and they have a lot of assets.
So how would it actually differ from this yield curve control compared to the QE playbook? And why might it actually be harder to unwind this time?
Yeah, a QE is just the central bank going into the secondary government bond market and buying bonds. They don't go straight to the auction when the Treasury sell bonds, because it would look too too Weimarish. I mean, buying debt directly from the Treasury. So they allow the primary dealers, mainly the Wall Street banks, to buy at the auction, and they go in and buy the bonds. Yield curve control is more of a, like a, not a threat, but an announcement to the markets that, for example, the Fed will not allow the 10-year yield to go above 4.5%. And if the market tests that level, the Fed will come and do QE to bring that yield back down to that level by buying the 10-year yield. That's the difference between QE and yield curve control. But they've been doing a mixture of both, I guess. In Japan, they're still doing QE.
So what can we learn then from the Japanification, let's say, of the US, but also the UK? We've also seen that the Gilts have been also showing some worrying signals. What is, let's say, something that might be repeated or that we've seen unfolding in Japan that might trigger something much deeper?
Yeah, I mean, Japan, people were always talking about the danger of deflation. And by deflation, they meant prices, the CPI shrinking, right? Not growing. And I always thought that was strange, because if the CPI is going down slightly, that's actually good for consumers. So they were adamant, and they're still adamant in Japan, to keep CPI and prices rising. They think that it's the Keynesian mentality, that they think that will keep the economy going. But what we see now in Japan is that people are feeling the pinch. And even there, the politics is changing, and people are angry. And their CPI is like 3 or 4% now. It's probably higher, because they always tinker with the number. And that's why their bonds are going down so sharply, especially the longer term bonds, and their yields are going up. So, and the gold price in Japanese yen, it's done better than in all other currencies. And I think they're going to try the same in the US. And it's going to fail. All it's going to do, it's going to debase the currency even more. It's going to raise the cost of living even more. I mean, we see President Trump calling for rate cuts, even though everything's booming in terms of financial indicators. In the UK, I think it's a little different, because the Japanese are big savers, and they have a lot of, even though the government has a lot of debt, 230% of GDP, they're big savers, and it's an aging society. But here in the UK, we're not that big a saving nation, and we have a lot of foreigners buying our gilts. So I think we might have a tougher time doing it than Japan or the US. We might be in the same boat as Portugal, Italy, Ireland, Greece, and Spain back in 2011, 2012, where we see people just dump the gilt, the gilt, the government bond of the UK, and yields will spike. And we're having problem now because we can't, we're not like a major reserve currency, and we can't just cut rates and do loads of QE to keep rates down. It would really impact our currency.
So you've mentioned now inflation and more particularly CPI, that you've estimated at 30% being manipulated. What do you believe is the true rate of inflation then in the US and in your case in the UK?
Yeah, I mean, the 30% number, I saw that someone post that on Twitter, that the BLS is estimating 30% of the basket, the prices. So they're not going out there and doing surveys and seeing what the prices are doing. They're just guessing. So it's not a great indicator in terms of the real rate of inflation. Well, I think you need to look at the real rate of currency debasement, because CPI really is measure prices. It's the consequence of inflation. And there's a lot of confusion regarding that, but I think it's done on purpose so they can manipulate people's perception. But if you look at the last 25 years, in all of the major currencies, gold has gone up about 9% every year for the last 25 years on average. So that means the currencies have gone down 9%. So that's what I think the real rate of inflation is. And that's why, yeah, people are finding it so hard and difficult to survive. Their wages and salaries are not keeping up. Like back in the 60s and 70s, you could have a family where the father went to work, the mom stayed at home, and you could afford everything. Now, both parents have to work and they're still struggling. It's because of that, because they've been lying to us about inflation. And how that affects everyone is that all companies and governments, they use the official CPI number to index wages and other things. So if they're lying about it, you're being shortchanged.
Yes, and gold is, as you always say, and well, on a very regular basis, through also your content online, is maybe the real gauge of measuring that debasement. And you've also recently, I think it was a few days ago, or at least when you were in Switzerland, shared a video about the fact that we're in the most extreme monetary era in at least 1,000 years. So why is that, and how does today's system compare to, let's say, ancient Rome or post World War I in Europe?
Yeah, I use the term in the millennium, I guess, 1,000 years, because I looked at this chart from Charts R Us, and they had gold, the gold price since the 1200s. And yeah, it goes steadily up, which means the nations or the kings and queens, they debase the gold, through wars and stuff. But then you look at the 20th century and World War I, World War II, and especially after 1971, and the price of gold is like a hockey stick, and something that never happened before. And yeah, that's the situation we're in, because prior to prior to, let's say, World War I, when there were major wars, for example, the Napoleonic Wars, there was inflation here in the UK because they suspended convertibility of the banknotes into gold. But after the war ended, they went back to gold standard. You could redeem the gold, and actually there was zero CPI growth up until 1914. Real debt went down in the UK. So that's what they used to do after the wars. They used to come to their senses and pay a lot of it off. But ever since World War I, they haven't gone back. They tried, I guess, during the 1920s here in Europe, and by the early 30s, it didn't work. And I think the reason it didn't work was that World War I was such a horrific and major war that, yeah, they completely bankrupted all the major nations in Europe, and it was really difficult to get back up from that. And then in 1971, it got really bad because we detached, currency from real money, i.e., gold, for the first time since since ever, I would say. And during the Roman period, they didn't have paper money. They didn't have banknotes. So the way they devalued the currency was through debasing the coins. And that took about 100, 200 years. But I think by the end of the 3rd century, and especially in the 4th century AD, the silver denarius had almost no silver. So that's how they used to do it. In the beginning, it worked, but then, the soldiers and the people that got paid with that, they realized that, oh, we got half the silver in this coin, so prices doubled. That's how it used to happen. But now it can happen really quickly because we use now digital entries and paper.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at GoldRepublic. At GoldRepublic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, securely saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at GoldRepublic, we offer real assets to safeguard your generational wealth. Yeah, so on one side, it's more controllable, but on the other hand, it's also giving more freedom, quote unquote, or possibilities for people to actually evade that panopticon or more surveillance-based system, which I would like to go or to address in a bit. But first, I would like to talk about the suppression mechanisms that are present in the monetary system. So you've said that recently they're desperate, and that's pointing towards like the monetary authorities, or more in particular, COMEX and the LBMA, about the fact that there's a surge in short volumes. There's a record in physical delivery as well, requests for the physical delivery, and a strain that can be felt, especially at the COMEX. Is it? Do you think now, like the great unraveling of this cracking in the system now really visible in real time? Where are we now in this stage?
Yeah, I think we are late in the day, and some people might argue, well, if they were manipulating the price of gold, how come it's gone up so much? But I think that wasn't really the point when you look at the fact that the gold contract on COMEX was created on December 31st, 1974. And that date is important because on January 1st, 75, gold was made legal again in the US. And there's some WikiLeaks documents from 1974 where US State Department and Treasury officials, they communicate, correspond with bullion dealers in London, and they say we need to do something about this because we don't want the public to go and start hoarding physical gold. So the dealer said in London, yeah, that's right. And he said the dealer said, by creating a liquid futures market that will negate that physical demand, because the futures market is leverage and it will like mushroom the whole physical market, and it will keep the market volatile, the prices, and it will put off the public. So that's how they do it. But now you have central banks, uh, non-Western central banks, accumulating gold hand over fist since 2022. And they don't buy futures, they buy the real thing. And that's making it harder and harder for this paper game to continue. And even on the LBMA, which is supposed to be a physical market, a lot of their trading is through OTC promissory notes. But when someone wants to take delivery, especially a big delivery, and regularly, it spoils the whole game. But I think it's natural that it will unravel, because it's what's been keeping the fiat currency system going since the 70s. And I think, yeah, they're desperate, because I think they know that the jig is up. And why do I say that? Is it just because I feel it? No, it's just because the debt numbers are so huge, not just debt, but also unfunded liabilities of governments, and also all the notional amount of derivatives out there, which could explode anytime depending on volatility. So yeah, that's how I see it.
And now I'd like to also focus more than on the silver market specifically. You've pointed out that there's a shorting of silver ETFs like PSLV as a tactic to prevent physical delivery. Can you maybe explain how this works and how it actually limits the price discovery in that context?
Well, and it's happened also in SLV, I saw the other day. What happens is, like the bullion banks, what they've been doing, well, it was a few months ago with PSLV, and the lease rates went up to borrow the shares. Um, uh, what it does is that if someone comes and borrows the shares to sell them, and then let's say the public comes in and buys the PSLV, they buy, let's say, 10 ounces, and bullion banks sell 10 ounces short, that nets to zero. And the rules of the ETF PSLV is that if there's zero demand, they don't have to get more physical. So what the shorting did is that it negated all the physical demand, all the demand per PSLV that would have had to be matched by physical, because the bullion banks were running out of physical for other markets, maybe the LBMA or the COMEX. So, and they didn't want these pesky retail people that were buying PSOV to get to change that, because the people who buy the PSOV, you can't really take delivery of the silver, but the trust that runs PSOV is supposed to buy it. So that's how it kind of masks the demand for real physical silver by them doing that.
Mm. And now if we think about other actors, and we've seen also past billion banks like JP Morgan, HSBC, having hefty fines about spoofing and all kinds of other practices. Are they acting on behalf of central banks, you think, or are they just protecting their own games, pure greed? They're just leveraging the Cantillon effect and this closeness they have to institutions? What's your take on that?
I think it's a bit of both. They do act for central banks, and the central banks they say, oh, we don't trade futures or gold, but the BIS does. And the BIS, who are the BIS's clients? Well, they're central banks. So I think that's how they hide it. But the bullion banks as well, for themselves, it's not very regulated market, because the bullion banks they trade gold and silver. It's in the foreign exchange market. Most people don't know that. Gold and silver are traded as a currency. So they front run a lot of times, probably orders from the BIS because they know it's a big pocket, big order. So yeah, it's a bit of both, I would say.
So let's say, and that's a bit of a too speculative question maybe, but you'll tell me what you think, is if we admit that the suppression, the manipulation is nullified, that it doesn't exist anymore, what prices in gold and silver will we see today?
Yeah, that's a really good question. There probably will be like no no gold and silver for a while at any price because no one will know, and the dealers, the bullion dealers, will have a really difficult time, and they won't want to uh, give a price because there's no idea. But it will be a lot higher. Um, yeah, I think people need to maybe get used to pricing things in grams of gold and silver or ounces, having an idea, because when that happens, what you said, I think there won't be any more paper dollar, paper euro, or paper pound or yen. The system will really have broken down.
And will this be maybe it's a naive question, but will this be a period when this suppression game is truly over, or are you watching for very particular signs like the gold silver ratio collapse, a total delivery freeze, ETF suspension? What are the things that you'll be looking at first?
I guess a lot of volatility in the markets, and then exchanges like closing for initially they have these rules where if the market goes up too much, they stop trading for a while, and then they reopen. But eventually, you will see maybe the COMEX and LBMA halting trading for a week or two, and then I think you will know that we are near that event.
So I also was wondering what your take is on the tokenization of gold. So a lot of people, especially in last year, when it was also brought up in the BRICS summit about the fact that there would be a digital BRICS currency and a basket made of different currencies, but also gold that will be tokenized. Do you believe in that? Do you believe in the tokenization of gold?
Yeah, I mean, I think they are trying to take us into a world where it's very easy to transfer financial assets, gold included, through tokenization. Um, yeah, I mean, I would be a lot more comfortable if, for example, if there were a token where you can buy gold or sell gold or transfer gold. Uh, I would be comfortable if I could go to a bank and say, I want my physical gold. I want to know that it's there because it's difficult to trust at the end of the day if you trust any institution. So, yeah, I wouldn't put all my eggs or all gold or silver through a tokenized system. I would still keep some physical because yeah, I wouldn't trust it 100%. But I think it could be the way forward. And amongst sovereign countries, they would probably use it a lot. It would be a lot easier to settle trade. But amongst us individuals, it's a different story.
So if, let's say, someone is in their 50s and they're actually waking up to the risk that is, yeah, like the current monetary debasement that we're witnessing, what kind of gold allocation would you advise? And knowing that those people might be sitting on traditional savings or some form of pensions, and now waking up to that reset risk, what would you say to those people?
Well, I just tell people what I think. I don't tell anyone how much they should allocate to anything. It all depends on the individual. If someone has done their homework and they really see this coming, I would try to allocate as much as possible. I guess people who have private pensions that are invested in the stock market, they might not be able to do as much, but if they are, do some, keep some of the stocks, I guess. If you have the physical gold, and what I when we have this reset, um, I think the amount of gold, let's say if you have 10, 15%, that will probably be a good insurance. If you have more, I mean, it would be even better. But if you're 50, maybe you're a bit more averse to risk. So that's what I would say. But don't I think the biggest risk is keeping fiat currency in the bank in terms of deposits, or that's the biggest risk. Of course, you need some of that to for your daily transactions, and maybe a bit to pay taxes. But if you're, yeah, don't keep hundreds of thousands of euros in the bank. That's the worst thing you can do in the current environment, I think.
And what about then physical, let's say coins, bars, legal tender gold coins, British sovereigns? How would you go about that? And what's the ratio, let's say?
Well, here in the UK, yeah, that's what people should be doing. Physical sovereigns or Britannias, because they're legal tender, and they are exempt from capital gains taxes. And it's all a matter of preference if you prefer 1 ounce coins or the sovereigns, which are just under a quarter of an ounce. I mean, it doesn't really matter, in my opinion. For other countries, I'm not really familiar with the tax rules and the situation regarding capital gains tax. But yeah.
So let's say in the case of what we've seen in 1933 with Roosevelt, and later on in a different way with Nixon in 1971, don't you think that there's maybe also a possibility to come back to the old playbook of just straight up confiscation? And what scenarios do you see unfolding in that case?
Yeah, I mean, back in the 30s in the US, gold was money. So everyone had gold. Everyone that had some money had gold. So the confiscation made sense. But nowadays, it's a small, tiny minority of people have gold. So I'm not too sure that if they would resort to that. They might resort to taking the physical storage for ETFs. They might resort to that, like confiscating the physical gold that, let's say, is held for GLD. It's a lot easier. It's right there at JP Morgan or HSBC's vault. So they could do that. So, but anything's possible. But the other way they could do confiscation is to let the price go a lot higher. And a lot of people that have gold would be tempted to get rid of it for paper, which would be it would be the wrong thing to do. You can get rid of your gold, of course, for other assets. If you need, let's say, to buy a house, or you want to buy a new car, or something like that, or you want to pay for your children's education. But to yeah, take profit, take profit on your physical gold because the price is going to 5,000, and putting it back in fiat, that is kind of the confiscation, really. So that's the way I think they'll do it. And I interviewed this guy from Italy a few weeks ago. His name is Andrea. I forgot his surname now. It's Cecchi. Yeah, Andrea Cecchi. And he said it's the biggest mistake is to, when if they go through this revaluation, is to get rid of your gold, because that will be how they'll do the confiscation.
And now to conclude this conversation, I was wondering what your perspective is on the viability of CBDCs, and more in particular the digital euro or the digital pound.
Yeah, I mean, viability, I mean, yeah, they're viable, but I don't think they're a good thing. You know, it's will be under total control by the central bankers. And that's not me saying that. That was the managing director of the BIS, Agustin Karsten, who said that. He said, we'll be able to control people's financial transactions really well. So, but here in the UK, I don't know, the Bank of England came out a few weeks ago and said that they're putting off the plan for a digital pound or Bitcoin for, I don't know why. Maybe they see that people don't like it and they're trying to back off a little bit. I think in the EU or the Eurozone, they're bringing it in October, I think the digital euro, and they say that it will run parallel. And yeah, I mean, we already have digital currency. I mean, when you use your bank app or you use your debit card or your Apple wallet, that's all digital. So yeah, it's very viable, but I think it's very dangerous. And I think the Swiss have it right. They had a referendum and they opted for no digital currency and for continued use of cash.
Great. Well, we're reaching the end of our time, Mario. I would like to thank you very much for your time, for your knowledge, and also guide the viewers towards your X profile, Maneco64, and obviously your YouTube channel. That also congratulations on the 150,000 subscribers. I think it's amazing. They grew quite a lot, I think, in the last months to what I saw. So any perhaps concluding thoughts or comments?
Yeah, I mean, what we talked about today seems really daunting, but I wanted to emphasize that it's not the end of the world and that the world is still a great place. And the only thing that's not good at the moment is the monetary system. And that can be fixed really easily because it's a human construct.
Well, on this positive note, or more positive note, and a more optimistic view of the future, thanks again, Mario, and hope to talk to you very soon again.
You're welcome.